have a have a bit of discussion around how our business, needs to evolve considering the challenges. Give me a minute. Let me just pick up my screen and share. I can't find it. One minute. Let me know once you can see my screen. Okay. Can you see my screen yet? Hello?
Yes, please. We can see your screen. We can.
Okay. So I think I just wanted to have a quick conversation as to how the businesses need to evolve, considering the times that we are in now. I remember a few years ago, not more than a few years now, the whole concept of VUCA started to become popular in the business world. VUCA meaning volatile or certain, complex and ambitious, business environment. But what we've seen in recent years really is more like an acceleration of that volatility. Okay. In the last few years, we've seen an increase in the volatility of our business environment. You can see on my slide, the first graph is basically showing the IMF World Uncertainty Index, and you see that since the 20s is where it ended the 2020, from 2018 to now, that uncertainty index has increased significantly. Essentially, the uncertainty index measures the volatility of business environments across the world. Okay, and according to the IMF, that's at its highest point since we started taking measurements about 60 years ago. That's amazing if you consider that we had the Vietnam War in 1960, we had the oil crisis in the 70s, the Gulf War in the 90s. What this index is saying is that never in history has our business environment been as volatile and as uncertain as we are facing today. So that's the big challenge that we are faced with. So before we talk about how do we evolve our business, the question is what's driving this uncertainty? What are the factors driving this uncertainty? One is obviously it is geopolitical risk, right? Because of the globalization that we have now, where our markets and the world is more connected, a geopolitical situation in one part of the world is having a ripple effect in the rest of the world, as we are seeing with Ukraine, Russia now, right? Same we'll see when that happened with China, in terms of policy on semiconductor, for example, and how that affected the prices of automobile. So our world is so interconnected now that geopolitical issues in pockets is having ripple effects across the world. So that's one. The second point is this whole digital revolution. Digital revolution is also causing a bit of disruption in the sense that now we are more connected, right? Yes, this comes with opportunities of growth, but it also comes with its own risk in terms of security risk, right? Cyber breaches, reputational risk. Now, if anything happens to one company this minute, before any PR activity, the rest of the world knows about it. It's on Twitter, it's on social media. So there's a lot of reputational risk as well coming with that digital revolution. The third point I wanted to mention was the whole thinking around the climate, right? Climate change and what governments are trying to do, to protect our environment. Now, yeah, that's having a very strong influence on policies, right? We saw the other day the meeting on COP26 where many nations signed to zero emission. So this is influencing the policies of various governments, right? Recently, I think there was a news yesterday in the United States about the limit of emissions. I know for sure that in the next, and I'm sure Martha knows better, in the next 1 year, IFRS is going to introduce additional standards linked to sustainability, environmental sustainability, and all of that, on top of what we already have on the financials. So all of this is creating, tension and disruption in the business, not to add the pandemic, not to add the whole COVID pandemic that we had. The Gates said recently that there's likely to be another pandemic, right? What's his name? Joe Biden said the same. So we probably have not seen the last of the pandemic. So we're in a very, very disruptive and uncertain business environment. So the question is, how must our business evolve to handle this business environment? That's the real question. Now, what this is forcing is that it's forcing a rethink of our traditional business models. Essentially, the way business models have been designed, right from back our father of wealth, Adam Smith, and all of that, is that businesses are designed to be more efficient, right? That's the way businesses have been designed. Okay. I'm pausing because of the background. Okay, sorry, I get distracted a bit. So the way businesses have been.
This is disruption, an example.
Exactly, this is an example of the disruption. Even the fact that we now have to do a lot of remote and adjusting to all of that is disruption itself, and we'll talk about that later. But the way businesses have been designed in the past is essentially to be efficient. So we're thinking of how do we build, leverage scale, how do we optimize resources to protect our bottom line. That's the way. So the whole concept of division of labor, all of that is to be efficient. Now, what this business model is for, what this disruption is forcing, is the rebalancing of the equation between efficiency and resilience, right? So we are now forced to think of how do we make our businesses more resilient. That's really the change that is happening from efficiency, yes, but now with resilience. That's the change that needs to happen. And let's talk about the whole our traditional business model. If you think about it, right, what did we used to think about? What did we used to say? What were the things we used to look for? And I put some words here, and I'm sure you guys have more, right? It's just be about lean. How can we be lean? How can we leverage skill, right? Cost optimization. Six Sigma was a big thing, right? Kaizen. All of this was around how do we, improve efficiency, right? So, but all of that, while being very good, had its own disadvantages in the sense that it was so structured, and businesses that were designed like that found it very difficult to adapt, and they were not nimble enough. And we saw this with the COVID, right? So many businesses suffered because of this, right? Because when you design processes that are so rigid, suddenly there's a disruption. It's difficult for your business to adjust to that change. So that's what's forcing this change from, okay, yes, we want to be efficient, but how can we also be resilient, right? It's essentially, if you think about the human body, for example, if we follow the principle of business traditionally, excess was a no, right? Why should you have two cars when you don't need two cars? One car can do more. So essentially the concept of do more with less, right? But the way it is now is you almost have to be like the human body, where you have two eyes, 2 ears, two hands, so that in case one fails, the other one is there to, support. That kind of concept, right, of resilience. That's essentially the change that is happening. But the question is, what exactly is this resilience? When we talk about resilience, what's resilience business model? The resilience business model is essentially more focused on sustainability, on preserving existence, right? Because like I said, the disruption is so much that it could really, really impact the business performance. So resiliency is about being able to anticipate, understand the disruption, and being able to react to the disruption. That's the concept of resiliency. But essentially it's two words. It's being robust in terms of, when this disruption comes, you're not overly impacted. That's essentially the meaning of being robust, but also being responsive in the sense that when this when this happens, you can bounce back and you can adapt to the change. So that's the whole thing that is happening around resilience. But they are different, and it's not like we've not always been resilient, really. The only point is, I think we've in the past focused on financial resilience, right? How do we protect the bottom line? How do we ensure that we continue to grow? But what this disruption is causing, right, is for us to focus on different the different areas of the business or in terms of resilience. But let's talk about these 5 areas of resilience. And probably this is my last slide, I think. The 5 areas of resilience. 1, financial resilience. This is the traditional one. Cash will continue to become the king. So more than ever before, it's important for businesses to generate cash because interest expenses is rising, right? We've seen in the last few weeks the federal banks increasing monetary policy rates. I think it's the same in Ghana, in the US. Countries all over the world are increasing the cost of capital, essentially. So interest expenses is increasing. It's more difficult to get cash, essentially. So part of financial resilience is creating a position where you have a bit more cash and protecting that portion. I think one change that is happening, and it's one that we're facing in my company as well, is what do you do with stock? I remember back then, the whole concept of working capital is that you try to minimize stock, right? As an efficient business, you want to minimize working capital, so you try to minimize stock. But as we move towards resilience, that's been challenged, right? Because anything could happen and suddenly you don't have stock. So suddenly businesses are trying to rebalance that financial objective with resilience. So now businesses are saying, okay, do I need to hold a bit more stock because the market is volatile? Exchange rate is going up every week. So imagine I buy stock. Imagine you had stock in January, for example, or in December, when exchange rate was $6 to a Ghana cedis, I think so. And you had stock up to June. I mean, it's probably too much. I'm just giving an example. But that's protection or edging yourself against that bed of exchange rate devaluation. So that's the kind of thinking that businesses are beginning to think about as to those financial priorities, rebalancing the financial priorities, and stock is one example, right? The other example is exposure to debt, and what type of debt are you exposed to, right? So there's one, being exposed to debt is fine in the business, but now business are to question the currency of the debt, right? Just like the government is always worried about dollar debt versus local debt. Is a question that business are beginning to answer, right? Dollar debt, yes, costs cheaper in terms of interest expenses, but if you consider the disruption that we are faced with today in terms of devaluation, there's that challenge to say, okay, do I go and expose myself to local debt instead, considering the disruption? Okay, so that's the thinking on financial resilience. That is the rethinking that is happening in that area. Secondly, operational resilience. This is probably where we're having the biggest change. All right. The world was moving to like I was saying, the efficiency model of having this sort of global supply chains. So many companies was thinking, why don't I have one factory here to supply the rest of the world? Why don't I have my factory in Ghana to supply Nigeria? So many markets, right? But now we are being forced to rethink all of that and move to a bit of what I'll call a global approach, right? Because what we are saying is that if you are over dependent on one supply chain, that efficient supply chain model, once there's a disruption, it's difficult to manage. Like we've seen with China during the COVID. If you're sourcing all your products from China, for example, suddenly China shut down during the COVID and your business is shut down, right? So businesses are beginning to, instead of saying, I have this one supply model, have plan A, B, C, D in terms of their sourcing models, right? Another example is even your local sourcing, your procurement. It made sense in the past, right, to consolidate all your sourcing to a few suppliers, because then you can negotiate better, right? If I had to source 10 bags, right, and I go to only one supplier and I say, give me these 10 bags, it made a lot of sense because I can negotiate better. But now if you think about resilience, right, you need to have more than 1, 2, 3 suppliers. Yes, it's probably going to cost you a bit more because you lose a bit of negotiating power. But that's the kind of thinking that we're having in terms of operational resilience and what's changing. Thirdly, organizational resilience. I mean, Tekla just mentioned one now. This whole concept of how do we work, right? How do we work? The remote working that is coming, the remote working that we are faced with, the type of skills we even have to recruit. I think this is one that we are still trying to get the hang of, right? I mean, the remote working, I think people are starting to understand. But in terms of the skills that you now need in this disruptive environment, I think it's totally different, right? Because what you are having as well with the disruption is an increase in attrition. I don't know if it's, I think that's what I see. I guess you business owners will probably agree with me as well. So really, there's a very significant increase in attrition. And this is calling us to question how we even recruit. For example, do you recruit profiles or do you recruit skills? Now, what recruiting skills means that your organization is very, very nimble and can adapt. So for example, I have someone in finance, right? But the person is in a finance role, but has the skill of, can also do IT. I'm giving an example, and pardon me if it's wide. Can do as software development skills, as this. So you're recruiting those skills into your organization such that if during the disruption, there is that loss of that skill in the organization, you can manage the organization to manage those skills. So those are the kind of thinking that we are having in terms of organizational resilience. Technological resilience, I mean, I already mentioned that. Now more than ever, businesses need to be driven by data. So there needs to be a bit of predictive analytics, data insight driven decision making. And technology is helping us to achieve all of that, right? Because now with technology, we're able to manage information in a faster way, and there's more speed. Okay. Lastly, or not lastly, and there's one more afterwards on the slide. Well, okay, business model resilience. Here is around what you do in terms of your consumers. Really, the consumers are changing as well, right? Our consumers are changing. Where they shop is changing. How they shop is changing. What they need is changing. How is our business model able to adapt to those changes, right? More important than ever now is this need for constant innovation. And that's where business model resilience comes in. An adaptation of our service models. How do we even serve the consumers? Our route to market models, right? Our customer contact models, right? Adapting and changing and making sure that we're able to, reach our customers through different ways is very important as we go through these disruptive times. Lastly, and I didn't put on the slide, was reputational resilience. It's linked to the consumers, but it's about creating a very strong relationship between brands and consumers, because that's what will sustain. That's what we'll be able to hold during, disruption, right? So, so that's essentially the thinking that is happening now in terms of, that's essentially the thinking that is happening now in terms of business models and how we are trying to evolve and change. I'm trying to say, I've not used too much time, how the businesses are trying to evolve and change and adapt to this disruptive time. It's about moving from a strong focus on efficiency to building more resilient businesses. Resiliency meaning businesses that can adapt, even at a bit at the expense of cost, right? But it's about survival and sustainability now, like building more sustainable businesses than more profitable businesses, if I may use that word. So that's the presentation. I know it was short. I think I had 15 minutes. Tekla, I'm not sure if I used more than 15. Hello, Tekla, Mata.
Yes, thank you so much. It's been awesome. I mean, within this 15 minutes, the things that I've learned, I don't know. I think you would have to come back again. Please, you would have to come back again and give us more training and elaboration. But I don't know if we'll have to do the questions now or we should wait for a second speaker. Tekla, what do you think?
I think we can proceed with the questions so Tala can continue with his daily activities.
Okay.
I'll stay the whole hour. It's fine.
So please.
The whole time. Oh, okay, sorry.
If you have any question for him, you can ask, then we can do the second one as well.
And
I think
someone's hand is up.
Lydia Doe's hand is up. Please go ahead, unmute and ask your question, please, Lydia.
Thank you very much, sir. That was quite instructive and insightful. I wanted you to, I think my thing broke a bit, so I missed a bit on when you were talking about how do we recruit, and who do we recruit for?
Yeah,
and the idea of the difference between, recruiting for profiling versus skill sets, right? And could you elaborate a bit on that and why? And the why?
Yeah. Okay. I'll start with the why. Always good to start with the why. So the reason essentially is what we are seeing with the disruption is also less, what I'll call less talent retention. Attrition is also increasing significantly, and you guys probably would advise me if that's true in your businesses. But we're also seeing a bit of what we call they call it great resignation, right? So many people leaving their jobs. And suddenly organizations are having to fix so many gaps in the organization, right? So the thinking now is, how do I recruit in a way that helps me to manage that? Imagine if 10, 20 people are leaving an organization so quickly, because the exit rate is so high. And there's always been attrition, but suddenly it's increased significantly. So now we're having to think of how do we adapt the organization to be able to manage in such situations. Now, the concept is, rather than recruit specific profiles, what I mean is, you want to recruit, for example, a finance person, right? The role is finance. But rather than just make sure that you are recruiting a finance role, what you are looking at in the person is the skills, right? Because maybe the person comes into finance, right? But of course, the person has the skill of communication, of managing people, or something like that. When somebody leaves a role that requires that skill, you can easily move that person to that skill, at least temporarily, while your organization manages. And I use software development, for example, right? People say, I want to recruit a software developer. Yes, but if you could just a simple software developer and suddenly the software developer leaves, you need to recruit another software developer. But imagine you had someone in HR that has software development skills, right? And suddenly you needed to fill a software development skill in your organization. You can just move and manage that need for the time being. So that's the concept of looking at skills rather than looking at profiles alone during recruitment.
Awesome.
So then it's more of widening skill sets.
Exactly.
Beyond
skills in the organization.
Profile.
Exactly.
Okay. Thank you. Perfect. I get it. Thank you very much.
Thanks, Lydia.
Awesome. Lydia asked the exact question I would have asked. So I'm very happy about that. Please, if there's any more questions we can ask before we invite the second speaker.
I'm just looking on my phone. I've had 4 questions that have been texted to me privately.
Please read them.
Yes. So the first question is asking, what is a business model and which is the best model for today?
Well, that would take a long time to explain, but let me try to explain in a simple way. Business model is essentially how you serve your customers, your clients. So if you think about things like, how do you deliver the products, what products do you produce, right? So what products do you produce, and how do you deliver those products to your customers? How do you reach your customers, essentially? The customer context that's the concept of business model. So product, pricing, promotion, all of that is part of business model. So the question is, what's the best business model for today? And that's what I was saying, that the way we've always thought about business models in the past is like to build something that is efficient. So an example, I want to be able to reach my customers in the most efficient way possible. The most efficient way possible, or that will reach many customers in very quick time, is what was always the focus, right? And let me give you an example. Maybe it's the branch in a bank, right? Customers come there, I don't go to the customers, and that's it. But what we are seeing is that you need to evolve more from just thinking about efficiency to thinking about resiliency, and which means adaptable business models that can adapt and are nimble, right, to changing situations, right? So if I use my FMCG, for example, the business model, right, was we produce, we sell to customers, those customers deliver to the outlets. That was the model of getting to our customers. They essentially go to the open market or to the retail store and they sell the product to the retail store. What we learned with COVID, right, was when there was a disruption, we couldn't sell to those customers. So companies that built those sort of business models only suddenly couldn't reach their customers, right? And we needed to start to adapt, right, and start to think about online delivery models, online contact models, selling online. So you saw an increase in retail store, in online shopping, for example. So changing your business model to be able to serve that online channel as well, as while at the same time being able to serve the traditional channel, is also part of the changes in business model. So the concept is essentially you are becoming more resilient. Another example I gave about business model was how do you even source the product, right? So the traditional way is that you want to source from as few suppliers as possible, right? Because you want to be able to negotiate more and get better offers. Right? If I came to you, for example, and said I want to buy 1,000 t-shirts from you alone, you give me a different price than when I come to you and say I want to buy 100 t-shirts, right? That was always the thinking. So you try and consolidate your sourcing into one. But what's happening now is because we are moving from that efficient model to a bit more resilient model. I'll probably have 3 suppliers and give them 300 t-shirts, right? Yes, it might cost me more, but it's better I have 3 suppliers because of the disruption we are having. One supplier could shut down for some reason, and then I'll be out of business. So that's the change that is happening in terms of business model, moving from efficiency focus to more resilient driven business models.
Okay. I actually do have lots more questions for you. So Tola, you may probably have to wait till after the session. Mr. Frimpong is ready for his session, so we'll switch and then we'll come back to you with the question.
Yeah, it's fine.
About 7 questions I have for you.
I'll wait. Thank you.
Thank you. So everyone, we have Dr. Richmond Frimpong with us, and he's a seasoned financial and economics expert. He understands figures, he understands the economy, he understands the impact on businesses, and he's here to share, to make us understand what the current economy's impact is on our businesses and how to financially position ourselves or our businesses in order to get good results. So without much ado, I will just go straight to invite Dr. Frimpong. If you may start, sir.
Yeah.
Thank you, Thekla. I think you can hear me by now.
Yes, clearly.
Excellent. So good morning to all our joiners. I'm just going to speak straight and very brief about how to make the best out of your business in these difficult economic times. I'm going to be sharing my slide in just a minute so that we can all follow the meeting. So let me know if you can see my slides.
Yes, from my end.
Excellent. Okay, so I'm speaking about the economy and your business, but I'm going to be talking about the wisdom you need to be able to, in these very difficult times, leverage on, even though the bad side of the economy, leverage on it and turn it around for your business. And so first and foremost, this is a background I'm sharing about the continent, particularly if you're in Africa. I think Africa has the biggest opportunity in these difficult times than anybody else. And so if you're a business on the continent, whether you are in Central, Eastern, Northern, Southern, or where we are in Ghana, West Africa, it's one of the best times to leverage on the wave and the challenge of the economic difficulties to make the best out of your business. Now, if you look at this background, you will notice that from 2020 up till about 2021, there are no positive projections. And that is a very bad sign. But one good thing about this background is that at the moment, the economy of Africa is just about turning for those who can leverage on one, exchange rates disruptions, and two, um, macroeconomic indicator disruptions like inflation and co. That as I move on, I'll be talking about. And so this particular slide talking about GDP growth is basically to say that GDP is a reflection of, for every economy, is a reflection of the immunity and the might of that economy in terms of production or in terms of income. So if you want to tell how a business is doing, you look at the reflection of the GDP in terms of its growth. And it is either in the production of goods and services or it's in the incomes of the people who are working. Now, if you look at this diagram, you will notice that GDP growth in terms of moving from negative to positive is at a very quick pace in Africa than the rest of the world. That is to tell you that even in the midst of the disruptions, production and service is somewhat giving a lot of income to those who understand the economies where they operate. That is where and so the curve turning to the advantage of the people on the continent. What that means is that by say 2023 to about 2030, if there is any economy in the world, or if there is any region in the world that is going to see a lot of growth, is Africa. And we are looking at a projection of between 128 million to about 2.6 trillion. So what is all this? Literally, what I'm saying is that if you are in business and you can do the right thing, even in this difficult time, you can do very well. And so what must you do then? The first thing you must ask yourself is, do you have immunity? Do you have immunity? So we say inflation is high. We say the forex is disrupted. We are saying that interest rates to loans that people take is high. We are saying that it's difficult to get people to buy your goods and services. We are saying that businesses are collapsing, among all things. The question is, are you taking advantage of what we are talking about? Are you taking advantage of this? And so when I ask about the question of immunity, I'm simply saying that just ask today that, assuming that business that you are running does not receive any sources of income coming into the business, beginning now, for how long will that business survive with the already existing income you have built and the already systems you have built without having to depend on, say, a bank loan or without having to depend on a government grant? Now, if you cannot survive for more than 6 months, then it means you have not built enough immunity for yourself as a business. Why? Because the disruptions we see are not going to end anything less than the next 10 years. COVID as a disease or as a health risk may probably decrease, but the implications of COVID on economies, the implications of COVID on businesses is going to last for not less than 10 years, a decade. That is why if you come back to this slide, the projection is between 2020 to 2030. And the data suggests that businesses that are going to leverage on the positive side of the downtime economies are going to do well and cash in. So even in these times, there are businesses that are tripling and quadrupling their returns, and there are businesses that are closing down. The difference in the two types of businesses is in the immunity they have built. And so if you're a young business, a medium-sized business, or even a large corporate watching, the key is to build immunity with the assumption that, let's say, the economies become so disruptive that you don't get any income coming in. You should be able to build immunity that gives you stability without depending on a loan or a third party, but being able to survive on the ones you have built before this period for at least 6 months. If you miss that, then you don't have immunity. So one critical thing any business must do is to use this test to check that, assuming my customers are not buying, assuming my receivables are not coming, they are not paying what they have already taken, assuming I am not getting any service to render that is bringing me money, for how long can I keep this business running? And if you check and it's not up to 6 months, then you don't have immunity. So what must you do? Begin to capture the existing costs you are running today, month on month, and ask yourself what the total is. So let's say at the end of every month, my expense ticket is about, say, 1,000 USD or 1,000 cedis or whatever currency it may be. You multiply that by 6, and then you begin to build an emergency plan through savings as a business that can absorb you and give you immunity and stability in case there's disruption, at least for 6 months. It is only when you do this that you prepare yourself to be ready to achieve what you want to achieve. The next thing you have to do to be able to take advantage of the economy, assuming it is in the state it is for as long as we can stay, is to now multiply your inflow sources. And for you as a business, it is very risky to check that the only cash flow intern that comes to you is one source. If it is just one source, then you are in trouble. And one of the critical things you do is to build a minimum of 7 different sources that bring and turn around your cash flow into the business. So you should ask yourself, what other way do I get income coming in as far as my cash flow analysis is concerned? If you can track that and it is less than 7, you don't have immunity enough. I mean, if you can get 4, it is great. But if you can't get at least 4, then you are not already in the game at all. Anything at all can throw you out of business. So what you do is to aim at 7. And the 7 is that you build your earned income from the regular business, and then you look at how you can now leverage on the profits you make after tax. And you define what happens to the profit you make after tax. And then you take that one from the profit after tax in sections. I mean, you divide it as to how you can survive and put some in instruments that can generate interest income. So one, build earned income that is the main business you are doing that bring you some return. Then out of that, look at your bottom line in terms of your P&L, your profit after tax. And out of that, do a distribution that makes you put money into something that returns interest without you having to open your shop, or without you having to open your office, or without you having to make a production or make a sale. Something that generates consistent interest income. And then as a business, now you have to organize your business well in the order of shareholding. And you can either take advantage of that through the stock exchange as a listed entity. And thankfully, if you're a small enterprise or a medium enterprise business, you don't need to go to the main base of the exchange. Now, there is an alternative base for young businesses that are supported to generate income instead of going for credit from the bank, because that is short term and it's quite expensive, and that capital is not patient. And so if you want to leverage on dividend income, then one of the things you do is to take advantage of the market and now take long-term income that is patient, so you can generate a dividend income that now comes to shareholders. That is another thing you can do, so that whilst you are running your main business that brings you earned income, you have profit income, that is the distribution you make from your P&L, that goes into an instrument that gives you interest income. And then you organize your business such that it can attract long-term patient capital that will in turn reward you with dividend income. The next one is now to look at rental income. Here, there are assets you have that largely you are not making any return on. And sometimes you can have assets like the cars you use, the motorbikes you use for your dispatch services, or even sometimes the office you run. And the office you run becomes a liability such that if it takes more than 25% of your total income that you generate, then no, you are heading for a difficult time as a business. So what you do is that you can turn that asset, be it a car, be it whatever, also into something that generates income aside what you use it for, so it doesn't become a liability. And when you do, you will notice that now you are making a minimum of about 5, because your earned income is a regular one that comes through the business. The profit income is the one you turn from the profit after tax. Then that gives you interest income, because you are now able to achieve some earnings because you have invested in something as a business. And then order and organize your business such that you can leverage on the capital markets, so you don't go to take credit that is short, and that is also quite high and expensive, particularly now. And then I said, some of your assets, turn it into rental income. That shop that you have opened, that 3-story, that big office, you could even share it and rent a portion off if you don't need it. Or you could rent that out, earn some income, go and rent another. Just yesterday, I was advising a multinational that there is an office that you are able to access. It's a shared office. You're able to access 3 times a week, and you pay less than 1,000 cedis. But then the address of that office location is an asset that returns you so much. And so why do you want to go and rent a whole apartment or a whole compartment for an office and sit in 7 days a week and pay so much of our 25% of your total income as a business? It is a liability. It's not an asset. So you make it an income earning instrument through whatever means, or even it's a car. You branded the car, and as chief executive or as operations manager, you drive it. It is a liability. Rather, you could let the car now become a vending car that returns you something, and then you reduce the cost of using that car, so you earn rental income. The last 2 is royalty income, where the business makes trademarks of the things it produces. So if it's a service, if it's a product, register it as a trademark, and you can now franchise it to other people in other regions of the world who may need that service. And so you may not be a branch, but your product, your idea will be returning you rental income. And if you took advantage of the dividend income, then another automatic income that comes from the capital markets is what we call the capital gain income. As a business, what I'm saying is that despite the difficult and bad economics that we are having, looking at the data and the statistics with GDP and all the macroeconomic indicators across the world, Africa is heading out with a bank. And so if you're a business on the continent of Africa, you are at the right place. You just need to take the right decision. Check your immunity first. And when you check and you don't have the right stability for at least 6 months, build multiple inflow sources. And when you build multiple inflow sources, another thing you have to do is to look at this table and now generate linear and residual income, depending on where you sit. Now here, if you are watching me, I'm going to explain these 4 different quadrants, and it will tell you where you belong. And based on where you belong as a business, you know what to do. So there are people who are just working for others. And at the moment, they have business as well. There are people who own a business. They are not running it themselves. They are doing something else. There are people who don't own a business per se, but they are using their expertise. So maybe a lawyer, an accountant, a medical doctor, and things like that. And then there are people who don't do any of these, but they just earn income, however, whichever way. And that money works for them. The point here is that whichever category you belong, you must let the money you earn make money for you also. Whether you're an employee, whether you're a business owner, whether you are self-employed, if you miss this quadrant where the incomes that come into the business, the income that come to you as an individual, also go to work the same way you go to work, then you are not going to survive these down times. And so, how do you do that? Understand the financial markets. Understand the financial markets. When we say financial markets for a business, it is simply what we call the capital and the money markets. Don't be bothered about the technicalities. I'll break it down. So financial market is like any other market anywhere. You go to Makola, you go to Kaneshi market. The difference between a Makola and a Kaneshi is that a financial market is regulated. And so it's not everyone who is there as a seller or a buyer. So that is the only difference. Other than that, it's a place, there is buying and selling, and there is profit making, among other things. But then the financial market is regulated. There is somebody who supervises as like a headmaster and gives regulations as to who can be there to sell, and who can qualify to come and buy. Now, that market distributes itself into two ways: the capital and the money market. So financial market has capital and money market. As a business, you need to understand this because you can leverage on that for free. And when you leverage on that for free, you will have very little to do with the bank as far as credit is concerned. When you have that for free, you would make more on the money you generate as a business and not just keep it also in the bank. So capital market is the market where you generate money for long-term purposes. And here long-term is 5 years and above. And then the money market is a market where you generate money as a business in a short term. And here short term means a year or less. Now, in between the two, you can do a mixture and create a balanced market. And so when I say capital market, I am saying that as a business, you can generate income through debt. And so, for example, your business, if it's looking for funding, can go and get itself rated and get bonds. So you approach the stock exchange or you approach a financial company that is into investment banking or anything like that, and we keep your books over some time. And when we keep your books, we value it and now prop it for debt. So we generate bonds, for example, for you as a private business, and we prep it for other people to come and buy the bonds. That is debt. So it doesn't give the people equity. They lend that money to you. But if it's a bond, it is patient. It is patient. It's not like a loan. And so you generate that through the capital market. Or you would ask people to now become owners of the business. And that is the equity. So that business you have 100% ownership of. You could take 20%, you could take 30, you could take 40, give it out as equity so others can put money equivalent of that equity into your business. And when you do, you leverage as a business on the capital market. The money market one, you now go into the money market and you either become a player, and here there's treasury bill, there's core market, there's commercial bills and things. As a business, if you can, don't depend just on your regular current account and savings account as the only account you have. It becomes a liability. In these difficult times, if you have kept your funds in any regular account without touching for the last 3 months or 91 days, it is a liability to you in two ways. One, the value goes down with inflation. Two, you make close to zero or nothing because no current account will pay you anything. And if it's a savings account, the highest it can do will be 5%. Now, if inflation is now 27 and that current account is giving zero and giving you rather bills, which is negative, or that savings account is giving you 5, giving 27.6, it means already for not doing anything, you are losing money as a business by keeping that regular account. So you leverage on the money market, the same bank account, the same bank, you tell them, this money I'm not touching for 3 months. What rate can you give me above treasury bill? And you'll be amazed that the same bank will now quote you a rate that will now add some extra revenue that you never worked for. That is how, as a business, you leverage on the money market. And when you do, it becomes a good thing for you. So 12 keys to take away after doing all these things. Number one, understand the economy for yourself. Don't let anybody be your interpreter of what is happening. Understand what inflation does to your company. Understand what inflation does to your cash flow. Understand what GDP means. Understand all the major things that you hear on the news. Google it, ask an advisor, and see how it affects your business so that you do a turnaround to leverage on it. Number two, every talent you are recruiting in these days, check if that talent and its cost is bringing an equivalent value in revenue. If you just recruit, if you just hire as a cost item on your operational expense, and you cannot tell the income that talent is bringing you, you are just increasing your pay bills and it will rather take you further down. Number three, track every expense you make to revenue. Every single expense you make in these times, what revenue is it bringing? If you cannot tell the revenue that expense is bringing, don't make it. And so before you do any expense, you should ask what revenue is it bringing? So you follow the money. Leverage on receivables. If there are any group of people you're expecting to pay you on account, by now, they shouldn't hold the money. By now, you should be able to even discount some of them so you get the money now and place them somewhere that will return you. If anybody is paying you something now and they are paying it in tranches and they are deferring it over even more than 3 months, leverage on that receivable, discount it, take it today, and it gives you something more. The next thing is to leverage on factorization. If you have put any fund anywhere and that fund is not returning you anything, discount it, take it now, and invest it better. Know your number one value enemy. Your number one value enemy on the economy in these days is inflation. Any money you are receiving that is with a client as a receivable who has not paid yet, that is sitting in your regular account, or that is on somebody who is waiting to pay you for the bill, check if as long as that money stays, it is paying you above inflation. If whatever you are making doesn't pay you above inflation, your number one enemy is the best disruptor of your business. So know your the number one enemy and make sure that it doesn't become a disincentive. Choose assets over liabilities. An asset for you is anything that brings income to you in the business. A liability is any money that takes money away from the business. So do a table. Ask yourself, what are all the items that take money from this business? And what are all the items that bring money into this business? Reduce the ones that take money and increase the ones that bring money. So that car you have branded for the office, is it bringing more or taking more? Decide on that. Choose assets over liabilities. That office you have rented, is it bringing more or it is taking more? Choose assets over liabilities. That lifestyle the business has taken on, is it bringing more or is taking more? Choose assets over liabilities. The number of staff you have today, are they bringing more or they are taking more? Choose assets over liabilities. So that determines how you are able to navigate your way in these difficult times. Audit your waistline. If you choose asset over liabilities, you see that you are auditing your waistline, and then take advantage of financial markets. It doesn't matter how small you are. You can sit now and get funding from the Ghana alternative market with barely nothing. That is long-term patient capital. I explained the financial markets. Take advantage of it. Take advantage of fund windfalls. In these days, there are funds that have been paid into government for young and small, medium enterprises. Leverage on them. They come out for free. Just yesterday, there was a grant facility of between 1 to 10 million USD that the German GIZ was giving for free. Do you even know about it? You leverage on things like that and you take advantage of those fund windfalls. Multiply your money and the income sources. I explained that in the seven pathways to do that. Neutralize Parkinson's law. Parkinson's law says that anytime revenues increase, expenses increase to match them. Check it as a business. Check it. You notice that the moment you notice you are making profit, you decided to change your car as a CEO. You decided to change your call cards. You decided to change your address and location. Check it. Neutralize it. Get to a point where before you spend 1 cedi, you are generating 10 times that amount. If you don't do that, you would always increase your expense to match your increased revenue. And as a business, you can't survive. Check your cash holdings and make sure it is net positive. Here, what I mean is that your cash flow statement, pay attention to it daily and make sure that the outflows and the inflows every day is returning a positive net cash holding. That simply means that every day when I check money I've paid out and money that has come in, I should have a positive. I should never have a negative every day, but you have to be deliberate about it and check it. It is when you do this that you build immunity so that the economy and your business gets in sync and you achieve the best of both. Thank you, and God bless you.
Wow. Wow. I mean, all this in this short time, less than 20 minutes. Wow. So we want to open the floor now for anybody who has questions. I know there are several questions. Our time is up. So we would give maybe 5 minutes to questions till maybe another time when we start all over again. So please, if you have a question, I think we have just about 5 minutes. This is too insightful. I mean, okay, so please, if you have a question, just unmute and go ahead because we have just 5 minutes to do that.
Okay, so I'll say I have about 20 questions, but I think we can just do the first one because our time is up and then he has to also rush for another program or meeting. So I will just give the first 5, Mr. Frimpong, and then the others will find a way to respond to them. Please, we have our email info@malarecords.org. If you have further questions, please share the questions to that email. We will get a response and respond to you at the right time. So first question, he says, where do I start from to multiply inflows? Where do I start from? The second one is actually a commendation. She says, I did not know about rental income. This is new to me. Thank you. The third question, are you able to take on corporate training? Okay, that's a good one. Then franchise of local brands, does this work? Then where to find equity investors in Ghana? I think the first 5 will continue with the others.
Okay. So multiplying your inflows first. Are you a business? Do you have a bank account? What account is it? If it is just current account or savings, start from there. Ask the question, the last 3 months, have you had a business account sitting in at a certain minimum amount that you have not made any return on? Go back to the bank, tell them, I want to keep this amount for the next 3 months. Pay me more than inflation. Without working, without opening your office, that brings you extra income that you have not worked for. That is where you begin from. So that is how you multiply it. The rest, I'm sure with time we can explain. The next one is about corporate training. Yes, I mean straight yes. If you get it, it will help you. So you talk to Mallet Ricketts, they will support you with that. And then the other is about whether there is franchise with local product. Yes. Trademark that service, trademark that product so that you can create franchise income out of it. And then where do we get equity funding? The stock exchange. If you're a middle-sized company, small company, the stock exchange has an upper house and a lower house, literally. The upper house is a listed base where big companies are seated. The alternative exchange is where young emerging companies are supported to raise capital for long term. And so go to the stock exchange, tell them you want to list on the alternative market, and that is how you get support.
Awesome. If there's any further questions from participants, if anyone wants any clarification. Someone says, please ask my question. Okay, so it's about the GIS fund you mentioned. The person is saying, how do I qualify? Where do I go? How do I benefit?
It ended just yesterday. We profiled all the MSMEs. It ended on 30th June. It's gone. But I think more are coming. So just be on the lookout. Look for grants. The grants are flowing in these COVID times. You can just access them.
Thank you. Wow. I think we can draw the curtains there. We are way past our time. Auntie Martha, I'll hand over to you. And it's been wonderful. Wonderful. Thank you, our speakers. We have to definitely get you back on. Tola, I'm still getting a lot of questions for you as well. So we'll have to find a way to bring you guys on and help. And for those who need further clarification, as you mentioned, corporate training are available. Please speak to us. We can make arrangements for you and then help each other out. Okay, thank you. Madam Mata, I'll hand over to you.
We want to say a big thank you to our 2 speakers. They've done great job. We are so grateful to them. We can't thank them enough. I'm sorry. And for everybody who made it, some got it at a short notice, but yet they rushed into it. It's so amazing. That's very encouraging. We are so grateful. We thank you for that. And then just watch out for this space because more of these will be coming. So just watch out and then tell other friends as well. So thank you so much. God bless you. Have a good day and happy new month. Bye-bye.
Thank you too.
Thank you. So we'll talk after.